Hello everyone, I am Imari Lush Arabe, a Bachelor of Science in Accountancy student, and today we will be discussing accounting for pensions and post-retirement benefit. I will be explaining what is the nature of pension plans and what are the different types of pension plans and how they are accounted for, so you can have a deeper understanding of how it affects the future retirement plans. The nature of pension plan are designed to provide income and individuals during their retirement years. Pension plans is very important because retired employees depend on the company for an income and other benefits in exchange for their services during their working years. Basically, it's a social and moral contract which the employee gives the best years of his life to the company or to the employer. When the employee is retired, then this benefit or money or funds will be provided and available. He or she work hard for all the years, and when he or she will not be able to work at the company, then the company will provide benefit to this individual. In short, it is accomplished by setting aside money or funds at the company during the working years. Pension plan provides employees with a degree of retirement security and often enhances productivity, reduces turnover satisfaction union demands. There are a couple of types of pension plan, and the easiest pension plan is what we call defined contribution plan. In a defined contribution plan, employer contributions are fixed in the plan rules. A separate account maintained for each member to which all contributions and earnings on these contributions are credited. The benefits are a function of both a total contribution made in the investment and performance of the fund. Example for this is the employer contributed 5% of the employee's pay. In this plan, the employer contributions a defined amount to the pension trust each period based on factors in their calculations such as age and length of service. Note that this is promise fixed, the annual contribution to a pension fund. The accounting for this contribution is straightforward, for the company just takes out of the cash the defined contribution amount that the promise and increases their pension expense by that the same amount. For example, if a plan promises an annual contribution equal to 3% of an employee's salary that amounts to 110,000 in a particular year, the employer would simply recognize pension expense for the amount of contribution. The employer would simply recognize pension expense for the amount of the contribution. Simply debit pension expense to 3,300 and credit cash 3,300. The 3,300 is calculated the particular year amount, which is 110,000, to annual contribution equals to 3%. A defined benefit plan is an employer-sponsored retirement plan where benefits are calculated on factors such as salary history and duration of employment. This benefit is usually in not-for-profit organization. Not all non-profit organization but some of it. Government organization and also unions. One difference is the amount of the benefits are known by the retiree, and this is important. The risk is with the employer because they are completely responsible for contributions enough to meet the cost of the defined benefits. The amount of this obligation is measured by the present value of vested and non-vested benefits using future salary levels. Vested benefits are the ones that employees are entitled to even if they quit. Some of the complexities that arise are from calculations performed by the actuaries because these are based on assumptions. These include life expectancy, rates of return, and inflation, or even the salary expectations. This is easy to tell how the accounting for defined benefit plan is much more complicated because it depends on future liabilities and expenses. In the actual accounting for the defined benefit plan, the company uses pension worksheets to illustrate the computation of their annual pension expense cash flow in their pension asset or liability account. In short, defined benefit pension plan is a promise to pay a fixed retirement benefit so the employer to pay benefit that's monthly until the person dies. This pension is based upon the formula of the number of years and the annual compensation, possibly age, and then some sort of factors. An example is an employee retires after 30 years of service with a final salary of 100,000. The annual benefits are calculated at 1.5% times the 30 years times the final year's salary. This 1.5% is essentially driven by the actual plan or the standard rates. What this person is going to get after 30 years of service is 45,000 a year. Simply, 1.5% times 30 years of service times 100% times 100,000 equals to 45,000 annually. Now, let's just think about this 30 years ago when this employee started working, then the organization started to create a liability. And the liability didn't start or wouldn't start until the employee retired 30 years later. And then the question is, become as well, how long does this person get his money? And then the question is, how long does this person or employee get his money? And the answer is, until they die. The risk here is that the risk here is that this person may live for 5 years after retirement or may have been one of these people that lives to 112 years old and live longer or whatever. And live longer or whatever. And so the issue becomes is it creates a tremendous amount of record keeping and planning and management because it's basically dealing with a lot of unknown risk. 5 components of pension expenses that employee incurs. First is the service costs ascribed to employee service during the period. Second is the interest accrued on the pension liability that increases the expense account. Third is the expected return from asset of the fund. Fourth is the amortization of unrecognized prior service costs attributed to employee service before an amendment to the pension plan. And lastly is the net gain or losses from the revisions in the pension liability or from investing plan assets. This increase or decrease of expense account depending on whether they are pension plan amendments or changes in fair values of the plan assets. An understanding of the defined benefit plan is in 5 main expense that the employer has to account for is necessary when looking at its many problems. Thank you for watching and listening. Good day!